Thank you all for joining us for this webinar for the Working Family Success Network Expansion Initiative. It looks like we've got some great representation here in the webinar. More than nearly 25 people on the call, representing all 4 states in WFSN, which is great. My name is Julian Haynes. I'm Associate Director of Programs here at Achieving the Dream. And yeah, I'm happy to provide some brief remarks here as we get going. Now, the purpose of this webinar is to build understanding of opportunities to deliver financial services to improve the financial health of college students. And we've got a great group of individuals who will help kind of lead us through various ways that we can think about these issues. We have Sarah Griffen, who is a key consultant to ATD on the WFSN team. We have Ashvin Prakash from the Center for Financial Services Innovation. We have Nancy Castillo, also from the Center for Financial Services Innovation. We have Wendy de la Rosa from Irrational Labs. And they will be walking us through a variety of some different slides here today and presenting this work. Just very briefly, some of the objectives that this group came up with prior to the meeting include sharing insights on how student financial pain points, and challenges, identifying behavioral elements that can pose barriers and mitigation strategies, showcase successful financial service models, and prep participants for those who will be attending the working session in Chicago. So with that, I would like to introduce Sarah Griffen, who will get us started here today.
Thanks, Julian. So thanks, everybody, for joining the call. I want to just spend a few minutes laying out the agenda and some of what we're hoping to achieve today. So as Julian did the introductions, we want to talk a little bit about the context of the financial products and services work inside of the Working Family Success Network and community colleges work, and how we think it can really strengthen the work that you're doing as you think about your implementation plans to really further the ability of students to retain and succeed in college by supporting them with financial products and services. And I want to just briefly note, and I'll note it again, that when we're talking about financial products and services, we're not talking about, as many colleges have had happen, credit card companies who want to make a profit, approaching colleges to sponsor their cards. We're really talking about financial products and services to support students that are cost-effective, affordable, and really about focusing on the student, not on the company that's promoting it. So we'll talk a little bit about that. We're then going to go through and talk about some of the CFSI will talk some about the financial challenges that college students experience. Some of these many of you talked about at the inaugural forum. Others CFSI is going to lift up from some research. Irrational Labs is going to spend some time talking about the behavior challenges that we have in trying to design good products that will help students to really succeed in terms of their financial health. Then last 2 pieces, or 3 pieces, will be talking about 3 potential products and services in our initiative that may be of interest to each of the colleges in developing. We'll talk briefly about a design meeting that about half the colleges are attending next week, and then there'll be some time for Q&A. So that's the kind of overview of the agenda. Alyssa, if you could go to the next slide. Thanks. So as everybody knows, but just to repeat, the strategy in community colleges involves intentionally integrating and sequencing the 3 distinct but related priorities, 2 of which we are not going to talk about today: education and employment advances, income and work support. And the 3rd, which is highlighted and is really our focus today, is about financial services and asset building. So this is really looking at both the financial education and coaching that many colleges are already doing, financial literacy, and increasingly trying to link them to affordable products and services that help students and families to build their self-sufficiency and stabilize their finances. So this, as many of you know, in this particular piece of it, is strengthening some work that's already underway in many of your shops to be able, your colleges, to be able to help students to stay in college so that they're not dropping out because of a broken car or because they've got a crisis, so that they're able to manage their money better. So that's really what we're going to focus on here and how this fits within the overall strategy. Melissa? So in being part of one of the three pillars, it really can address some of the financial challenges that are faced, as I said, while also preparing students for financial stability in their post-college lives. And this is something that you'll hear about as Irrational Labs talks about some of the thinking about behavior and how helping college students to reset or change how they manage their finances and approach their financial health can help them not only in college but for their full lives. Within the WFSN and community colleges, it really is, we think, a key low-touch strategy in that pillar that can be scaled, and particularly when we pair it with financial literacy education or coaching. So you may already be designing some of the financial literacy education or coaching. This is a piece of a low-touch strategy that can significantly help your students, and we think is pretty easy to scale. And so in other settings, in working family success networks, in community-based organizations, and in some colleges, participants have been building and repairing their credit, establishing savings, and have been able to maintain employment because of using similar products and services. And so that's really why we want today to talk to you about the plan around developing some products and services specifically for college students to help their financial health. Alyssa? There we go. So I think I'm turning it over to Ashvin now. There we go. So Ashvin's going to go through and talk about financial challenges for college students.
Thanks a lot, Sarah, and hello, everyone. My name is Ashvin. My colleague Nancy and I are part of a consulting team here at CFSI. CFSI is the nation's leading authority on consumer financial health. We lead a network of providers to help improve the quality of financial services in the marketplace. We're very excited to be partnering with all of you today and thinking about the greater opportunity for community colleges to offer financial services to students. CFSI has done a lot of research in the past to better understand the financial needs and challenges facing students today. And we think there's really a huge potential impact that community colleges can have by offering well-designed products that can help students overcome some of the financial burdens that oftentimes before may have been barriers for them in achieving long-term success and completing their coursework. So in our presentation today, we'll first take a look at better understanding some of the financial needs and challenges we find amongst community college students today. And then we'll really dive deep into the three core financial challenge areas that we will be focusing on as part of the WFSN strategy as we think about developing prototypes for community colleges to hopefully pilot over the next year or so. So let's start by taking a look at what we know about the financial profiles of community college students today. We find that relative to four-year college programs and private institutions, community colleges really serve a financially vulnerable population. Close to half of students served by community colleges are lower income, and more than a third are the first in their family to attend college. Students at community colleges are generally older, and so this is representing probably a greater portion of people who are head of their household, have dependents, working one or multiple jobs. So given that this is an older and lower income population, community college students have fewer resources to pay for college education, and we find that 83% have a documented need for financial aid. So overall, community colleges today are really serving a large segment of the U.S. that we would consider to be financially challenged, just based on their income and lack of access to financial resources. And we can see the impact these challenges have on course completion rates. Financial challenges continue to be the leading cause for dropout rates among college students in the U.S. For community college students in particular who are already financially stressed and have limited access to resources, this is a huge barrier in helping them succeed in completing their classes to secure higher paying jobs. So we can begin to see what the impact financial stress can have on students and the opportunity here for community colleges to increase student retention and success by helping them address some of these long-term challenges. So we've thrown around a lot of terms so far. We've talked about financial stability, financial stress, financial vulnerability, financial challenges. But what are the outcomes that we're really striving for? At CFSI, we've really centered our discussion around thinking about financial health. And financial health means when an individual's day-to-day financial system functions well and overall increases the likelihood of long-term financial resilience and opportunity. So when we break that down, really we're talking about how a person manages their day-to-day financial services, things like paying bills on time, budgeting appropriately and not overspending, to build the longer-term resilience and have access to savings and improved credit profiles so that in the long term they have a good credit rating, they're able to grow their assets and make longer-term investments like buy a house or save for retirement. So that's our vision for financial health. When we think about how to apply this to community colleges, really think there's a big opportunity here to help students improve their financial health. And when we think about the day-to-day management, it's around helping them find ways to manage their day-to-day financial management around paying bills, managing their finances, spending appropriately and not overspending or taking out too much credit, helping them build resilience and weather ups and downs by building a financial cushion by continuously saving over time or having access to credit, affordable credit, and in the long term enabling them to have access to long-term financial growth and opportunities. And we find that by helping students improve their financial health, community colleges can really help better position students to handle financial challenges that before may have been a barrier to them staying in school, and also teach and build positive financial behaviors that over time will help improve their ability to succeed financially in life for them and their families. So within the WFSN strategy, our work over the next few months will be identifying prototypes for community colleges to consider piloting to drive the financial health of students. Specifically, we're looking to dive into the following 3 core challenge areas within the financial health framework. The first challenge we'll be looking at is the ability to manage cash on a day-to-day basis. So whether it's looking at volatile income and expense flows or helping students live within their means. The second challenge is really around helping students build some kind of financial cushion over time so that, as Sarah mentioned, they're not one flat tire or one broken car away from graduation. And lastly, the third challenge we're going to focus on is helping students have access to opportunities to build or repair their credit profiles so that they have these longer-term opportunities. I'll turn it over to my colleague Nancy now, who's going to shed some more light into each of the 3 challenges we've highlighted here.
Nancy, I believe you're muted on the line.
Sorry, thank you so much. This is Nancy Castillo, and I'm just going to now take everybody through the different core challenge areas that Ashvin talked about a little bit more specifically to see what they really entail and the effects that they have on people's lives. So the first one is around the inability to manage cash flow as well as one could. And, in thinking about the research that's been done, the work that we've done at CFSI, key insights have been that there's a high degree of income and expense volatility among U.S. households, and there's limited usage of budgeting tools among households as well. As Ashvin was saying, a lot of the community college students really are part of this financially challenged population, which affects a lot of us. I definitely can relate in certain circumstances of these things, and it affects a lot of people, and a lot of it is related to community college students as well. So here, according to some recent research by the Federal Reserve Board, 38% of people in the United States report that their families are just getting by or struggling to do so. And when we look a little bit more specifically at this, we're seeing that there's a rising cost of living that's quickly outpaced growth in wages, and it's impacting minimum wage earners the most. We're seeing that 53% of households work multiple jobs over the course of a year. 64% of households receive variable non-recurring income, so having to do with self-employment, casual employment, stuff that just isn't regular, isn't super reliable or can be variable. We're seeing that 63% of households budget only mentally or not at all, and that having a bill or payment due before a paycheck is a leading cause for usage of costly loan products. So a lot of this definitely has a ripple effect into then what it leads to other challenges that people encounter. To give you a sense of a household that really exemplifies this inability to manage cash flow well as one could, and other things that we've been talking about, their challenges, is households that's called Sam and Sarah Johnson. It's a household from the U.S. Financial Diaries research that CFSI did in partnership with New York University. And here we're going to focus on Sarah. So Sarah is a 38-year-old, hardworking mother of 3 dependent children, and she is a bookkeeper full-time, also works part-time as an athletic assistant, and she receives educational grants, and she's pursuing a college degree in the social sciences. So she's definitely receiving lots of different types of income. And her husband, Sam, also works multiple jobs. He also has a full-time job and then a few other jobs as well to make ends meet. Due to the nature of the part-time and casual work that they get, and also Sarah's educational grant that she gets, their income has spikes and dips from month to month and can range anywhere from around $4,000 to $9,000. The more pronounced spikes happening when she receives her education grants in the month of September and January. In addition to this, this household has experienced frequent unexpected expenses. They've had home repairs that they've needed to do, they've had car repairs, and they've also had health issues that have come up. When we looked at their expenses, in the research that we did, only about 20% of their expenditures are fixed, and these are, the mortgage payments, car payments, insurance payments that they know are coming, and other other sort of, regular payments like gas, utilities, communications, food, that accounts for about half of their expenses, but they vary month to month. And then in September, they had these huge spikes in expenses when they had to buy a new car because their old one became unreliable. And this particular household lives in Ohio, in the Cincinnati area, and in that area, public transportation just isn't as convenient, isn't as reliable, so they really needed to just get that car. And they paid for the home repair when there was a leak in the basement. So these things make their money management difficult. Sarah is able to manage the short-term expenses pretty straightforward. She thinks about her paychecks and say each paycheck goes to a bill, and she prioritizes the mortgage and the car payments. And then she pays everything else with whatever's left over. She uses a checking account and pays bills online and automatically or manually, depending on which bill it is. And it works well enough for her for these unexpected things. It's when the unexpected happens that they experience a shortfall because they don't have a cushion. And as a result, in these months, it impacts other aspects of their lives. They downgrade their food choices at the end of the month as they're trying to economize. And when money's been particularly tight, they've had their cell phone or utility been cut off, have been cut off for failure to pay the bill. Or they've even delayed taking prescription medicines. So just this, struggle of just, trying to manage your day-to-day stuff has effects in other aspects of your life. And what happens is they try to seem to cope by the situation by using a lot of credit cards. So they've really been ramping up a lot of debt in addition to the other loans they have, like the home loan and the student loans that she's getting. So, the core challenge of this household really revolves around managing multiple forms of income with inconsistent cash flow in a way that's effective for them, and could potentially be addressed by income and expense smoothing tools or tools that really help them manage their money day to day. The other area is around the lack of a financial cushion. And this is one that I've raised in the story that I just shared with you about Sarah, and can be seen throughout many households in the United States and similarly among community college students. So here we've really seen that savings were depleted for many households after the recession, and as such are less resilient against emergency expenses. And a lot of this lack of savings is driving the usage of costly small dollar credit products. And so again, from the Federal Reserve Board, the recent report that came out showed that only 39% of people in the United States report that they have a rainy day fund adequate to cover 3 months of expenses. So the cushion just isn't there for a lot of people. Specifically, we're also seeing relatedly that 76% of Americans live paycheck to paycheck with little to no emergency savings. Almost 50% of Americans could completely cover an emergency without selling or something or having to borrow money. So the other half is having to do those things in order to cover an emergency. Nearly a third of users of costly small dollar credit products borrowed to cover an unexpected expense. That was the trigger point for them. 66% of users of small dollar credit products had no savings at all. And 62% of households with no emergency savings indicated they would be able to save at least $25 a month. So in some cases, there is an opportunity here to build a cushion. In many instances, it's just that people don't, have that, haven't made it work for them to be able to have this cushion. So, and to give you another example of how this affects someone in their lives, I'll talk about Carla here, who's a single mother, 28 years old, works full-time as a waitress and cashier, while also studying to become a nurse at a community college. Her annual income is around a little bit under $30,000, and she struggles to make ends meet, let alone set money aside consistently. As a significant portion of what she makes goes towards her bills and her rent, so there's little left over. As such, when unexpected things come up, she's had to drop out of classes on more than one occasion and pick up shifts in order to make ends meet, in order to really make sure that she can still take care of her child. So her core challenges here are that she has a limited accumulated savings and access to additional capital resources. And these things could potentially be addressed. There's a solution area here via high-quality emergency credit vehicles or improved opportunities for savings. The last one is around the ability to really build credit. So, this really affects and really touches on the long-term opportunity that people have, including, of course, community college students and what happens post-completion for them. So according to FICO, 40 million individuals, that's 1 out of 5 people, have a very poor credit score. And these damaged credit profiles can affect all sorts of aspects of one's life. Here we see that 34% of scored consumers have subprime credit scores. And a little bit more statistics around this is that, lower income families with less education are more likely to rely on costly and low quality small dollar credit products, which of course then impact one's credit score. We can see that then it affects what they can have access to. Nearly a third of small dollar credit users don't qualify for a credit card. Here we also looked at millennials. Millennials are in the age range of 18 to 34, which really overlaps a lot with an age range of a community college student. And here in recent research, we've seen that 34% of millennials engage in 3 or more costly credit card behaviors. And these behaviors really, include carrying a balance, paying only the minimum, being charged late fees, being charged over the limit fees, and taking out cash in advance. So those are sort of the costly credit behaviors that we're talking about here. 43% of them engage in costly non-bank credit in the past 5 years. Among community college borrowers, 25% defaulted on loans within 3 years of entering repayment. And as I mentioned before, damaged credit really results in significant increased costs in the form of higher interest rates on credit cards and mortgages and higher car insurance premiums. It really just has a ripple effect into what you're able to access. So really just briefly, we earlier in the first story that I shared, we saw how that really impacted Sarah Johnson, and here I'll talk about how it impacts Carlos. So Carlos is a 33-year-old retail manager who had many credit cards in the past, and he has a student loan. He values financial mobility and security, and he's really thinking about long-term. He wants to put his kids through college. He wants to make sure that he's saving enough for retirement. A few years ago, though, he was laid off from his job at a retailer and relied on savings that he did have at the time and credit cards to get by. So that's sort of, he didn't have a cushion. He thought he used sort of those things, or he didn't have as much of a cushion to really carry him through. So he used credit cards. He also stopped paying his student loans in this time. So after 10 months of unemployment, he was able to find a steady job, but during this unemployment period, many of the cards were frozen due to non-payment, and he suffered significant damage to his credit profile, because of this non-payment and also because of the student loans that he didn't pay. So as a result, now that he's back on his feet, he finds it difficult to obtain a fair-priced credit card. So for him, again, his core challenge is damaged credit profile, and then as a result, limited access to affordable credit options. Potential solutions for him could be a pathway to improve this credit, and have more affordable, high-quality credit options. So those are just sort of to give you a better sense of what these different challenges really entail, what they really mean, the different ways that they impact people's lives, and you'll see that it's really a stream. They're really related to each other and they impact one another. So I think we're going to take it now to Wendy to give you a better sense of more of the behavioral aspects.
Great, thank you, Nancy. So now that we've talked a little bit about how we have influenced our college community given their concerns around financial health, we thought we would talk about their behavioral challenges. So my name is Wendy de la Rosa. I work with Irrational Labs, and we at Irrational Labs study how and why we make decisions. We are a nonprofit that helps organizations walk through behavioral design and marketing problems, really with the science and the data behind all the academic research that's been done on choice architect. So with that, we thought we'd start off and just reiterating a little bit of what Nancy and Ashvin have said around the fact that financial health is a critical problem for students, especially community college students. We know that two of the main self-reported reasons for students dropping out relate to financial concerns. Either they need to go back to work and make money, or they couldn't afford the tuition and fees. And so not only is this something that it's affecting how they view education, but it's also affecting completion and progress rates. The common approach to solving many of these problems has been so far to educate students on how to save money without really coupling it with behavior interventions. And the challenge for that is that we know that financial literacy without any behavior-based programs explain very little in the variance of differences in financial behavior. So a very large study covering over 160 papers have shown that the variance that's explained by just giving financial literacy and not coupling it with behavior-based programs explain less than 0.1% of the differences in financial behaviors. So again, financial literacy programs alone, while helpful, without behavioral-based interventions, are not necessarily working in the way that we hope them to do. We really need to think about this behavior piece. And before we start thinking about how to design and create these programs to help our community college students really succeed and be able to manage their cash flows and have a financial cushion and have the ability to build credit, we have to first try to understand the psychology of money, how you and I and our community college students think about money, and how you and I think about choices. So how do we make decisions within this realm? So focusing on the psychology of money to begin with, what we know about money is that we categorize and treat money very differently depending on where it's coming and where it's going. And this is the phenomenon that we know in academia as mental accounting. And so if you think about how you treat your paycheck versus how you treat your bonus, it's essentially very different, and you use those different sources of income for different purposes. Many of our students, when they get Pell Grants or loan refunds from their federal loan programs, they receive a very large cash flow inflow. And because it's not seen as a paycheck, or it's sort of seen as this bonus, they don't necessarily attribute it to different categories, such as tuition or paying for car or paying for food, much like they would do if it was a paycheck. So one of the leading academics in this field, who is the University of Chicago professor, Epley Nicholas, did this very interesting study where he focused on Boston area residents who received tax rebates back in 2001. And for one condition, they said, this is your tax rebate, think about it as a bonus income. And then in another condition, they said, this is your tax rebate, think about it as withheld income. And for that condition that's viewed it as bonus income, over 87% of those people spent their tax income on large purchases, a new TV, home remodeling, etc. Whereas when we describe the tax income rebate as withheld income, only 25% of those people spent it on large purchases. So again, as we're thinking about designing products for our community college student population, how can we highlight mental accounting so that our students view whatever income they receive, especially from federal programs, towards tuition or books or scholarships versus any of the other expenses that they have in their lives. The next real concept that everyone's susceptible to is this concept of opportunity cost neglect. And this is just a very fancy word to explain why we fail to recognize what we're giving up when we make spending decisions. And so in a very nice study by Shane Frederick, who's really the leading academic on opportunity costs and spending behaviors, he's a professor at Yale University, he asked people whether or not they wanted to buy different things. And in this one example, he asked them whether or not they wanted to buy a DVD. And in one condition, people had to choose whether or not they wanted to buy it or not to buy it. And in another condition, they had to decide whether or not they wanted to buy it or keep money for other purchases. Both conditions made exactly the same decision, right, whether or not they wanted to buy this DVD. But what we find is when we add language around keep money for other purchases, the people who are likely to buy that DVD decreased from 75% to 55%. And so we see huge changes in behaviors just by alerting to people that by spending money today, you're giving up something in the future. So again, as we're thinking about how to help our students with financial health and thinking about all the opportunities that we have and you guys have, given your roles at your respective community colleges, we should really focus on framing and how we can help our students think about this opportunity cost that they're neglecting. So now that we've talked about those two big important concepts of the psychology of money, we should now think about the psychology of choice. So how and why do we make choices, and how do we make it easier for our students to make the right financial health decisions? So one of the main concepts whenever we make decisions is this concept called hyperbolic discounting. So hyperbolic discounting really values the fact that the present for us is much more important than the future. So we put an unrealistic high value on the here and now and an unrealistic low value on the future. So in one condition, we asked students whether or not if they wanted to receive $1 today or $3 in the future. And in that condition, most people want $1 today, right? Who's to say what happens tomorrow? But when you ask people whether or not they want $1 in 1 year or $3 in 1 year and 1 day, most people choose the $3 because it's much easier for us to make better financial decisions when the outcome is in the future than when it is today. So how does this relate to, our students? We can think about different ways where we can help them make decisions about the upcoming semester or the beginning of the semester earlier on so that they don't have to make these trade-offs right in the moment. It's really hard to say, I want to save today when you have a bill that's coming due today. But it's really easier to say, I'm going to save $20 tomorrow or $20 in some future, and I'm committing to it today. The other concept around choice that we're all susceptible to is this concept of default bias. So we tend to make the easiest choice possible, and oftentimes the easiest choice possible is not doing anything. We know that's true when we have complex decisions, and financial health decisions are one of the most complex decisions out there. So this is a very interesting study that was done by Eric Johnson and Daniel Goldstein in 2004, where they looked at donor rates across different countries. And if you can see the chart, you can see that Austria and Germany have very starkly different donor rates, organ donation rates, even though they have very similar cultures. And so they wanted to study why. And when you dig into the research, what you find is that the reason for these stark differences for organ donations, a very important and personal decision, doesn't necessarily have to do with culture or different views on organ donation. It has to do whether or not the default choice was to opt in to be an organ donor or to opt out to be an organ donor. And what's interesting about the study is that when you ask people why did they choose to be an organ donor or not, they don't say to you it's because the box was already pre-checked for me to be an organ donor, or the box was already pre-checked for me not to be an organ donor. They rationalize their choice in their head. And so for our college students, if we want them to build a resilience emergency fund or become much more resilient to getting by a broken car, or really having a financial cushion, we have to think about how can we make it as easy for them as possible to build a savings account. How can we do automatic enrollments? How can we make that the default choice so that we can help them get to where we want them to be? The last concept I want to talk about is choice overload. And it's this concept where we tend to not act when we're faced with too many choices. And so if you think about standard economic theory, many people believe that the more choices we have, the better. And in reality, when we look at choice architect, in fact, the more choices we have, it becomes harder for us to make a decision, and thus we don't do anything. So in the next study done by Sheena Iyengar, she asked customers whether or not they wanted to buy a jam can. And so in one condition, participants were shown 6 different types of flavors of jam. And in another condition, participants were shown 24 different flavors of jam. And what we find is that in the 6 jam condition, customers were 6 times more likely to actually buy a jam than in the 24 jam condition. And so what does this mean, again, for our college students? We want to be able to, whenever we design a product that, again, will help them manage their day-to-day cash flows or build their long-term credit or build a resilience cushion, we want to be able to think about how do we minimize the number of choices that they have so that they can be more compelled to act. And these are very key behaviors as we talk through the psychology of money and the psychology of choice. We really want to set up students up for success. And a big part of that is setting them up for success for financial health so that they can in turn graduate and really get to high completion rates. So with that, as you guys are thinking, for those of you who are going to be joining us for the workshop next week, we want you to start thinking about how can we use these principles to design something that works for your students at your college. So I think I'm going to pass on the presentation back to Achieving the Dream, but we'll stick around for more questions.
Great. Thanks, Wendy. This is Ashvin again from CFSI. And now that we've kind of had a chance to hear about the core challenge areas and some of the behavioral challenges that Wendy just talked about, we just want to spend a few minutes highlighting some efforts that we're seeing in the marketplace in addressing each of these challenges. So while many of the products we're going to highlight here aren't necessarily focused on community college students today, what we really want to highlight and talk about are the concepts and design features that people are using, similar to what Wendy talked about, in addressing these behavioral challenges to help spur some ideas amongst all of you as we think about our strategy session next week, where we'll try to come up with some of the prototypes for community colleges to prototype over the next year. So within inability to manage cash, what we're seeing in the market are some attempts to introduce income smoothing tools. Programs like MRDC's Aid Like a Paycheck and Center for Economic Progress's EITC Advance Loan look at times or moments in time where a customer is getting a big inflow of cash, whether it's a tuition disbursement, aid disbursement, or a tax refund, and how you take that big inflow and spread it out over a period of time so that consumers are more likely to budget that cash and to manage it appropriately to meet their day-to-day expenses. We're seeing utility companies do this practice as well by offering budget plans that help customers better manage more predictable expenses over time, rather than dealing with high utility bills in winter and low bills in the summer. So that's one strategy to think about as we're thinking about solutions for community colleges, just how do we help them better manage these financial shocks caused by big inflows or outflows. Another strategy that we've seen around helping people improve their ability to manage their cash flow is really helping them better understand what their cash flow is and what kind of spend behavior they're engaging within today. We see a lot more banks and financial service providers offering these portfolio management tools within their products that let students or that let customers go back and kind of see how they spent their money over the past month or the past year, what different categories they spent it on, and kind of pushes them to create budgets and to plan ahead. So products like the Virtual Wallet by PNC or a micro-budgeting tool by Juntos encourages participants to set monthly budgets for how much they're going to spend within each category. So things like this can really help, as we think about students and, putting a budget together and sticking to it, some kind of integration of this can help move financial education more into the spend side. Around financial cushions, we're seeing more and more providers think about ways to reduce barriers and incentivize savings. Programs like Keep the Change by Bank of America or Save More Tomorrow by UCLA built in these default savings contributions so that customers have to kind of commit to a savings plan over a longer period of time, and over time through automatic contributions they'll grow their savings. So kind of what Wendy was talking about before, removing the barrier of choice and just making it more of a default behavior can help improve engagement with these products. And then on the other hand, you have groups like Doorway to Dreams and Save Up that are incentivizing people to save by kind of gamifying it and offering prizes every time someone makes a smart save, and having like a lottery system so that people see it more as a game and are more encouraged to engage with savings behaviors. Another strategy that we're seeing around increasing access to affordable credit is around more kind of products that are tailored towards meeting the emergency financial needs of customers. So many community colleges today are already offering some kind of emergency loan to students to access in case of an emergency. We're seeing other providers look at alternative ways to underwrite or think about the risk associated with these loans and being able to expand the credit to different populations. And a key component to all of these programs is making them easy to access and available at a time of emergency, and helping reduce some of the risk for the lender. And using these touch points, if a client's coming to you who has a financial emergency and doesn't have a cushion, using that touch point to kind of help them build the behaviors over time so that in the future when they have the same kind of experience, they're in a better position to manage that rather than having to seek out some kind of expensive loan product. When we think about the ability to build credit, which is a key challenge, and think about individuals with damaged credit or with no credit profile, we're seeing products in the marketplace that offer a pathway to damaged credit or new to credit consumers to establish a credit profile over time. So products like credit builder loans, List has a really exciting product that customers put down $30 every month towards a loan, and over that period of time they're building their credit profile, and then at the end of the program they're matched on whatever they contributed over that period of time, and that's shown to have significant impact on the credit profiles of people who are newer to credit. In addition, products like secured credit cards offer a low-risk way for lenders to offer some kind of credit component that's secured by the borrower, where they can start to build their credit profile just based on their day-to-day transactions. So with all of these, low balance credit lines, it's important that they all report to the credit bureaus and they provide limited risk to both the borrower and the lender. We're seeing some innovations there in how you get more and more people into that pathway to bigger credit over time. So those are just some ideas that we've seen happen in the marketplace, and hopefully can help inform the brainstorming session that we're going to be doing next week with some of you on the phone today. Really excited to work with you next Tuesday here in Chicago, where we'll be spending a day trying to identify and explore different financial products and services that community colleges can offer to improve the financial health and completion rates for students. And so, we look forward to working with you and partnering and moving into the next phase of developing the prototypes. With that, I'll turn it back over to Sarah to talk about next steps.
Thank you. So you've gotten an overview of some of the concepts and thinking that the team from CFSI and Irrational Labs and Achieving the Dream has been thinking about. And so just briefly to lay out where this is going overall for the initiative. So as Ashvin was just pointing at, next Tuesday, about half the colleges are coming to help us think about how to design the right elements of products and services that will help students to stay in college and to succeed. And the three areas generally that we're looking at, Ashvin just touched on a bunch of them, are the questions around income smoothing, withstanding sudden shocks, the emergency car repair, and also the building and repairing of credit, which is, of course, not only for once you leave college, but as was pointed out in one of the examples, helps people to access better cost credit while they're in college, which can be very important for even their utility bills and their credit card payments. And then we'll be also talking about how it all connects to coaching and financial literacy and education. So the goal of Tuesday is really to learn from you what the structures and processes are inside your college, and think about these three areas and what kinds of products and services, what are the kind of framework that we're going to need to develop generally for these products and services. Based on that, CFSI and Irrational Labs are going to put together prototype design frameworks, as it says here, that will then help a select number of colleges, and I'll talk about that in a minute, to design specific products. So we're just doing kind of what I would call, we're going to have general outlines in mid-October of what these designs of prototypes might look like. And then we're hoping that 4 to 6 colleges will be interested in implementing one of these services or products. And then there will be some individual technical assistance. You'll identify that in your November implementation plans. And then we'll be providing technical assistance individually to the college to make it fit inside of your college context and to develop something that works from your operational context and what your students need and what your college needs. We'll then be having small tests of these products and services from January to May or June to really understand in small batches how this might work. And from then, kind of moving from June onwards, learning lessons from that first phase of testing and really creating a wider dissemination strategy both within those colleges and with the other WFSN and colleges in the network. So that's really the plan here, is that next week we're going to begin designing that prototype. From that, the folks who know financial services and behavioral economics will develop those frameworks. Colleges will select if they want to participate, and we again are hoping for 4 to 6, and we've not quite determined the process if there are more than 4 to 6 of how we'll figure that out, which ones will participate. But we'll give some robust technical assistance to get those products ready for a small test launch for the first 4 to 6 months of the year, and then from there really learning the lessons from that initial implementation to bring it out more broadly throughout the network. So that's the plan for this overall work, and it's why we today wanted to really set the frame of the different challenges of students, the possible products and solutions, and the ways to use understanding behavior and behavioral economics to shape some products and services that will really help your students and will be accessed. So that's where we're headed, and I don't know, Julian, if you want to say a couple of words or if we should turn to question and answer for the last 10 minutes.
I think we should open it up for Q&A.
Okay. So Alyssa, what is the protocol for folks? Because I think everybody's muted. Are you going to open everybody's line?
So there are 2 different ways that you can ask a question. If you would like to talk to us on the line, if you want to just raise your hand, I can unmute your line. Otherwise, the alternative way to ask a question would be to type your question into the question pane to which I can read the question out loud and then we can respond. I did have a question come in while we were going through the webinar. One attendee just asked which colleges were participating in the design workshop. And so each college received a few emails about this opportunity, and the following colleges will be participating next Tuesday. Phillips Community College, North Arkansas College, College of the Ouachitas, Walla Walla Community College, Eastern Shore Community College, Skyline College, and Porterville College.
And Alyssa, if I might jump in, this is Sarah. If I might jump in, we're very appreciative of the design work. If you're not participating, it doesn't mean that you might not be able to implement one of these prototypes. We're really very appreciative of folks coming next week to help us think about the design, because if we don't root it in the operational realities of colleges and the needs of students, then it's not going to be successful. So next week is really to establish kind of the frameworks and really get everybody thinking together. And then all colleges will have the opportunity to think about including it in their implementation plan, the draft of which is due in the middle of November, as you all know. Are there other?
No questions have
while we're waiting for questions, was there another one, Alyssa? I'm sorry.
Oh no, it's fine. I just said no questions have come through in the questions pane, and no one has raised their hand. So I think we can give maybe a minute more for people perhaps hesitating. Otherwise, you can feel free to follow up via email. The WFSN email is on the slide, and Julian and I regularly check that. So if you have any questions, please contact us.
And I also want to, while we're waiting to see if there are any final questions, I just want to check in. There's a survey that came out to you about, that's related to this, about financial product services and what's going on in your colleges now. And if you could take a moment to fill that survey out, that is helping to inform how we design these products and services. And I believe our deadline is tomorrow. So we'd really, really appreciate it, because we are using it to inform next week's design session and how we're going to design the products and services that will work within your colleges. So if you could, that would be great. Julian and Alyssa, that was sent out again yesterday, correct? Or was that today? Did you send out a reminder about the survey?
Yes, I believe we sent a reminder yesterday for a deadline of tomorrow, and we can remind again to make sure they have the link.
Yep. We greatly appreciate the answering of that. Okay, I think if there's no other questions, Julian, do you want to wrap us up?
Sure, Sarah. Thank you, and thank our presenters from CFSI and Irrational Labs for setting the context for this very important piece of the work, and we really appreciate your time, you on the webinar as well, to participate and join us in this webinar. It's a very exciting portion of the WFSN work, and we're all looking forward to kind of hashing out what this potentially look like as we work toward implementing the WFSN strategy generally. Thank you, Sarah, also, and Alyssa. And as Alyssa mentioned, if there are additional follow-up questions, please feel free to contact either Alyssa or myself directly, or to the WFSN email account. We'd be happy to talk offline about any questions you have leading up to the meeting in Chicago next week, or about this work generally. If there are any other further comments from the panelists, or Sarah or Alyssa, I think we can conclude this webinar, and we will send out a recording of the webinar to all of you to share with those perhaps at your college that weren't able to participate today. But thank you again for your participation. And again, as Sarah requested, please complete the survey that was sent out and submit by close of business tomorrow, Wednesday. ACD will again send it out to make sure that it's at the top of your email, so you see it, and hopefully you're able to submit to inform all of this work moving forward. So thank you very much, and we look forward to being in touch with you very soon.